This video I'm making is not for the faint of heart, right? So if you're someone who gets offended easily, or you're somebody who has a strategy but you're not willing to bend, then this video is not going to be for you, right? But in this video, I'm going to be going over the mindset behind order flow, right? So if I just start from the scratch, right? So I've made this presentation to specifically go over a few things, right? So by the end of this video, I hope to, or as the title says, right, change your mind forever. And so if you're trading any kind of strategy and you're not using order flow, I want you to take a good look at yourself and ask yourself, what are you doing? Right? So we've moved past this idea of looking at, different sort of concepts, right? So sweeps of liquidity, right? What does a sweep of liquidity actually mean? All right. So when I hop on calls with people all the time and I ask them, what is a sweep of liquidity? And more importantly, what does it mean to you? Because the problem with liquidity is that, number one, it exists above every high and above every low. And it exists above every candle and below every candle, right? So if you look at all the candles you see over here, there is liquidity above and below every single candle and every single high and low. So when you look at that and you ask yourself, well, liquidity exists everywhere, right? So your sweep of liquidity can happen at any time. In fact, I'm recording this at 2:30 in the morning in the UK, right? Asia session. There is liquidity being swept right now. Should I be trading? Well, probably not, right? Especially if you're a US stock, you're trading US stocks or the US stock market. Trading the Asian session is not going to be wise. But liquidity exists everywhere. And so by definition, your strategy would work everywhere. Right? So if that's what you think the strategy is, then this video is going to help you either change that mindset or you can just hop off now, right? There's no point explaining this further, right? There is liquidity everywhere. So waiting for a sweep of liquidity is not valid, right? That's not part of your strategy, right? The second thing is market structure shifts, right? So market structure shifts, again, by definition, are happening everywhere, right? Not as much as liquidity. But if you look at a market structure shift, right, what you're doing is you're drawing an M, or you're drawing some kind of W, right? You're drawing something that looks like this, right? So if I kind of take this over here, what you're doing is you are drawing this, right? You are doing this basically. You're drawing these, right? That's not really how the market works, right? So that isn't something you want to do, right? Again, if this offends you, please keep watching. Now, the next thing is these, right? So FVGs and IFVGs. And so these are one of the most common things used in the entire trading space across every single market. Fair value gaps and inverse fair value gaps. And so the question is, again, fair value gaps, as you know, exist everywhere. FVGs exist every single day, right? They get created every day. There's probably one being created right now in the Asian session. The question is, why are you relying on sweeps, market structure shifts, and fair value gaps to predict $1 trillion market when you don't even know how they move, right? So that's sort of the main kind of concept I want to get to. So again, it's not an attack on any one strategy. It's about taking whatever strategy you think you have and applying the right concepts to it. And so that's the only kind of way to trade in 2026 and beyond, especially in this world of, if you believe in it, AI trading and algo trading. If you actually want to know what the markets are doing, you need to read what the markets are doing. Right, so that phrase is going to come up a lot in different ways. If you want to trade the markets, or you want to trade quote unquote price action, you need to understand how price action works, and more importantly, you need to read price action when you trade. So reading price action doesn't come down to liquidity sweeps, market structure shifts, FVGs, support and resistance, a big one. Now that's a huge one that I see, right? So support and resistance and trend lines. So one thing I'll say is that you cannot come to a multi-billion or even $1 trillion market, right? Forex, even the stock markets, for example, US stocks or whatever it is. You cannot come to any of these markets, start drawing up lines and expecting the market to bounce, right? A very common thing I hear from traders is they will draw multiple taps and they will look for multiple rejections, and then they'll enter where they see a momentum candle, right? None of that means anything, right? Momentum is a concept from physics. Momentum is a physics concept, meaning it doesn't apply to the markets, right? There's no momentum tracker in the markets that can help you see an impulsive move or a high momentum move, right? Those things don't really exist, right? You're trading the market. You're not seeing a physics exam, right? They're two different things, right? I come from somewhat of a background where I understand momentum and impulse. That doesn't apply here. Nor do your angled lines, nor do your support and resistance, nor do your FVGs, your market structure shifts, or your liquidity sweeps, right? These things are in abundance, meaning they don't matter. They don't matter. So you can't actually trade without order flow, right? Because the market is an auction. It's not a show. It's not something to tickle. I think a lot of people, they enter the markets because the market's very good at tickling your ego. Because you can do one of these things, right? You can draw a line. You can draw a 63.2-degree line and see two taps, and the third tap will work, right? Or you can draw horizontal lines, or you can find a fair value gap because you watched one of ICT videos. You can use market structure shifts or liquidity, right? These are either fancy words or overly simplified words, or overly simplified actions that gives you a result. But what you don't understand is that you cannot trade without order flow because the market is an auction, right? It's not a show. And it's not this kind of theater that some people create into a theater where they're using the market to kind of justify their own ego. So every market you see, whether it's Tesla, Apple, Forex markets, Bitcoin, gold, any commodity, anything that you trade comes down to the second point, which is supply and demand, right? Supply and demand governs the price of almost anything that we look at or touch, right? Even the markets that you look at. So the ones that the market that you are looking at right now, for example, on the left is ES futures. That is the S&P 500. However, this applies to the S&P 500, the Nasdaq, US 30, all the Forex pairs, gold, Bitcoin, silver, even things you can't name, they all come down to supply and demand, right? The price of an asset or an instrument will fall due to an oversupply and will increase when there's excess demand. And so that same basic principle needs to be applied to when you trade. It's not any of these things. It's not the lines you draw, the sweeps you look at, the shifts you look at. It is simply an auction based off supply and demand, right? So the auction helps you read where supply and demand levels are. So predicting the markets as opposed to understanding how to read them is grossly egotistical, right? So that comes down to one of these things, right? These are grossly egotistical things to do because what you're doing is you're taking a line, a box, a rectangle, maybe even an EMA, for example, and you're coming into a multi-billion-dollar market and you're trying to guess where the supply and demand zones are, not read where they actually are, and then wonder why you're not making money. Right, and so the fourth thing which kind of ties it all together is that the market leaves clues on what it wants to do and what it has done. So your job is to read those clues, not kind of make your own clues up and then go from there, right? Because that is number three, what I said, grossly egotistical, right? So again, auction, supply and demand. That's it. That's literally how every market works. So these are what we call visual interpretations, right? I call them cartoon characters of what the order flow is actually representing. So the market is an auction and nothing else. So what that means specifically is that if the market is an auction has a buyer and a seller. That's it. That's all you need to understand. The market is an auction. It's made up of buyers and sellers, and that is the only thing that it entails. It doesn't cover anything else, and I promise you this, right? So there's no reason why you should be coming to the charts and looking for anything other than buyers and sellers, supply and demand zones, right? Because it is an auction. The market is an auction. It's nothing else, right? That's step number one. That's point one. The market is an auction. So when you look at a candlestick chart, right? So this is now gold on the 15-minute time frame, right? So I've drawn one level over here, right? So this is based off a fair value gap, for example. This is the big fair value gap over here, right here. Now, the question is, I am not looking to trade off this fair value gap without understanding the basic concepts happening inside of it, right? This is where I see almost everyone going wrong. So if we just go to the 15-minute time frame here, you kind of want to see what's going on in these zones. So here and here, for example, right? So I'm making this not as an order flow education because I've made previous videos on that. You can go and check that out. But you know what I'm trying to get at is for example, right, I see a lot of these, like this is a high momentum candle. No, it's not, because you can't read momentum. Momentum is mass times velocity. That's a concept from physics, right? You can't take a concept you learn at 16 in a physics A-level class and apply it to the charts on gold, right? Gold is super popular, especially where I come from in the UK. Gold is super popular. Now, I don't understand why gold is popular, but if you want to trade gold instead of investing in it, if you want to trade gold, why don't you trade it instead of taking a physics concept of momentum and applying it to the charts, right? That doesn't make no sense. This is not a momentum candle, right? What's really going on here is you want to look at the price action around fair value gaps, around breaks, around liquidity sweeps, right? Most of these concepts don't work because you don't know how to make them work. Not because they're scams or someone on X is a scam. No, you didn't know how to make it work because you don't understand the interaction between buyers and sellers. And that's the simplest way I can put it. You cannot trade or click buy and sell without understanding where the buyers and sellers are sitting, right? If you're trading without knowing where the buyers and sellers are sitting, either watch this video or just hop off now. Just click off now. What you want to understand, I've been through this in previous videos, is you can see here we're breaking above with, the only term you want to use is we're breaking above a price. So everything's about price. So this is GC or gold futures. We can see here it's 5100, 5110, and we can see price breaking above this level. But what's going on inside the candles to give you any indication as to whether to go long or short? Because you want to read the auction. Right? There's nothing else that matters. You just want to read the auction. So if you can't read the auction, maybe start reading the auction, right? So for example, this candle here, right? This is something that just immediately came to my attention because of the way it looks. Again, it's not the momentum. It's not a nice candle. It's simply how the market looks, right? It's simply what the candle shows me inside, sorry. This is a green candle. We have this red box over here. It's a green candle with a red box, which means the market is obviously moving higher because of the green candle, but we can see a red line inside here. This is the delta. You should know that from previous videos. There is aggressive selling before the market moves higher. And so this confirms that we're at an area of demand, right? That's what I was talking about with supply and demand, right? That's basically how the market works, right? So the market is an auction, right? The market isn't a liquidity sweep. You're not looking for a breaker structure, an FVG, support resistance, trend lines. None of those things matter. It simply comes down to the fact that the market is an auction and nothing else. You either read that auction or you get wiped out. And so this particular chart over here, what you can see here is you see a lot of blue delta or aggressive buy orders. From previous videos I've discussed that, and we can see the market shooting down from here, right? So this is an aggressive, these are aggressive buy orders failing. So this is an area of supply. So this is the next thing I wanted to get into, right? So ego versus execution. So ego is the biggest enemy of your execution, right? Because let's go to the charts right now. Let's break this down. So if you go to this is obviously the ES futures or the S&P 500. Now, if I go to that exact day, for example, right? So this was a lot of chop over here, so not the best example I can give you, right? But when you're looking at this example over here, I'm going to try my best to break this down so people can understand it, right? This is the chart over here. Now, the way that I execute is pretty damn simple. So it comes down to three things, and this is what you want to understand from a mindset perspective. So from a mindset perspective, right, because I'm making this video on the mindset of order flow, right? That's literally what it comes down to. Now, this is what you don't need, right? So from a mindset perspective, this is how you want to think, right? Market is an auction, right? Market is an auction. And so your job is to read the auction. And so what I put on the slide over here is basically how if there's one kind of phrase you want to take away, is this, right? Ego is the biggest enemy of execution. I'm going to repeat that again. Ego is the biggest enemy of execution. So this was a trade that I executed on for that day. So that was sort of here, right? So this was the execution over here. So I'm going to break down how I did that. So from a technical perspective, the technicals are very simple if you're willing to learn them and just apply them every day, right? Applying them means taking a loss and coming back to the charts and applying the same system again. Obviously, that only works if you have an order flow based system. If you don't have an order flow based system, then again, keep watching or click off at this point if you're not interested. But I'm just sick of people coming with, sweeps and gaps and God knows what, right? They know what they need to do, but they think they're above doing it, right? Which is the main sort of thing over here, right? So, if you look here, for example, there's no sweep, fair value gap, liquidity sweep, or any of these things that can help you here. What's really going on is the price action in two points here, and then we had our retest, and maybe second retest over here because we had a bit of a choppy day that day, right? You are looking for a key level, and you need to understand the buyers and sellers inside that key level, right? That is literally the only thing you need to do. So anything outside of that contributes to what I've just said. Ego is the biggest enemy of execution, right? Ego is the biggest enemy of execution. So when you look here, for example, right? If you were to look here and you were to see this kind of chart over here, yes, it's a choppy price action, but you're seeing a rejection here, you're seeing a rejection here. Now, those rejections are not because of rejections, right? So people try to make these circular arguments. I look for nice candles, impulsive candles. I look for momentum blocks, rejection blocks. This is ego, right? It's ego because you're trying to trade a multi-trillion-dollar market without understanding how it works. It's like trying to drive a truck without a license. You're going to kill someone. You're going to crash. You're probably going to harm yourself in the process. It really does come down to that in the end. So just understanding this can help you kind of fast forward into your, into your sort of journey, right? So another example of a, Discord trade that I took here, for example, right? Again, we have the 15-minute opening range breakout. We had break, retest. We're entering short here, right? So there is no entry model. There's no sweep. There's no breaker structure. There's nothing here which indicates that you need to go short, right? The indication comes not here, but here, right? Because what you want to get used to is you want to get used to putting your stop losses in areas of absorption, right? This is the most important thing. You want to put your stop loss in areas of absorption. So you want to see here, okay, we had break, retest. We can see a lot of aggressive buy orders. Again, if you don't understand what this chart means, I've made tons of videos explaining exactly how aggressive buyers form, how aggressive sellers form, and you want to watch those videos before you take any execution. But here we have break and retest, and this here is essentially where you put your stop losses, right? You put your stop loss here in areas where you can see a break. So this is the break, this is the retest, and we're entering short here. We're entering short after the aggressive buyers get swept. So the main point here is understanding ego is the biggest enemy of execution, right? So ego versus execution, what is the difference, right? So a lot of people think they're executing, but they're really executing on their ego, right? They're not actually executing in the markets. So candlesticks versus order flow, order flow is going to win. Heiken Ashis, I've just heard people using Heiken Ashis. I'm not sure exactly what that is, but it's some kind of a Japanese candle. Fancy name, but again, it's ego, right? So are you on the side of ego or are you on the side of execution? And you really want to think about this in 2026, right? Because a lot of these strategies have been battle tested and none of them have come out on top. Candlesticks versus order flow, right? Heiken Ashis versus order flow. ICT and SMC, infamous concepts, versus order flow, right? Volume weighted average profiles, or VWAPs, versus order flow. Elliott waves, I've just heard traders use that. I don't know what that is. Support and resistance versus, that should say order flow as well, but support and resistance and trend lines versus order flow. So again, it's ego on the left and it's execution on the right. Because again, I'm going to keep explaining these concepts, right? So the market is an auction. We're looking at number one. We're still focusing on number one, right? The market is an auction between buyers and sellers. Your only job is to read the auction. So the question you want to ask yourself, similar to this, is are you executing in the markets or are you executing on your ego? So you either execute on the markets or you execute on your ego, right? So it's candlesticks versus order flow. So you want to pick, are you on the side of ego or are you on the side of execution? So step 2 now is supply and demand. So we're using our same example. So this is another concept I want to discuss, right? So supply and demand, right? Every market that you trade, every single market that you look at comes down to supply and demand. Whether you accept it or not, or like it or not, every market you see comes down to basic supply or demand. Right, so that is literally how every market works. So the reason we had the market selling off here, for example, is because we had an oversupply. Right, we had an oversupply. So if you're taking a short trade, for example, so we break kind of below this zone over here, we have our stops, let's say above here, and we're targeting down here. So there's an oversupply over here. It's not a difficult concept to understand. There's an oversupply in all these regions which are causing the market to tank. Right, that is the reason why the market moves down in the first place. There's no other reason for it. And so if I show you on the footprint charts, right, so you can't tell that there's an oversupply which caused this short on the S&P 500, right, or ES futures. But when you again, it's execution versus ego, right? Even looking at it, right, you can begin to see, wow, we had this huge wick over here, right? This massive wick, right? Yes, it's a little body or whatever you want to call it, doji or whatever name people call it. But the truth is, you're executing based off buyers and sellers and the interaction between buyers and sellers. There's no other way to get around this, right? In 2026, there's no other way to get around this. So I'm just going to put the numbers for you so we can see. So they're the numbers. And we want to kind of dive into what's going on here, right? So we can see this small body, huge wick, right? We can see buyers at this area. So what we see is break and retest, right? Even here, we see this retest, we see aggressive buy orders, right? If we just kind of zoom in, aggressive buy orders, blue delta. Same over here, blue delta, right? So we see aggressive buy orders with no real reward, right? So that's what creates the downside moves. So once again, I'm going to ask the question, are you executing on your ego or are you executing the markets, right? That's a rhetorical question. I'll let you decide. So if we go back to the markets now, an oversupply in any market results in lower prices, right? And a greater demand, if demand outstrips supply, then we will have higher prices. And so if you are trading without knowledge of supply and demand, or without at least acknowledging that supply and demand drives prices up or down, then you are in the wrong industry, right? You are in the wrong industry. And so we're gonna keep going back to what we discussed, right? So sweeps do not create upside moves, right, or downside moves. Market structure shifts don't do that. Fair value gaps don't do that. Support and resistance with random lines don't do that. Trend lines don't do that. None of these things do that, and you cannot trade the markets without order flow. There's literally no way to do it. Like, I am shocked at the number of people who try and trade without order flow and then blame their psychology for messing up, when in reality you're driving a plane without a license. You're flying a plane. You're flying a plane without a license, blindfolded. That's what you're doing. So another way to look at it is predicting versus reacting, or more importantly, ego versus execution. So execution comes down to reacting to what the market tells you. Predicting comes down to what did your ego kind of thing, right? So I'll break this down in a real example for you so you can see, right? So if we go over here, let's take this one down. So here was a trade that I took on the, I think it was the 6th of March, Friday, 6th of March, right? So the PA was choppy, right? The price action was choppy. We've had some chop recently, but it doesn't really matter. We can just take smaller trades and better trades, right? So had a slightly wider stop. Had my stop here, targeting the next key level here. So roughly about a 1-to-1 risk reward, nothing more than that. So the question now is, in fact, I'm going to just ask people here. So a lot of people, what they'll do is they'll see breaks of structure like this, for example, right? They'll start doing stuff like this. They'll see a break of structure here. They might see a fair value gap getting respected here. You know, they're seeing this FVG, blah 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 blah. You know, however, they're missing a very basic concept, right? So, I mean, taking a loss here, for example, right? Let's say you tried entering at this fair value gap here. That would probably result in a loss, right? Depending on how you managed it, or a break even. So by you, and then they're going to get chopped, right? Then they're going to go through this chop over here. So then what typically happens, right? Let's break this down. First they use outdated concepts. First they try and use this market structure shift, fair value gap, and then they try and enter here or something, right? Because they saw some break over here, yay, and then, you know, this happens. So the question now becomes, those people have no idea what's going on here, what's going on specifically here and here, right? Boom. You want to know what's going on here. That's not a smiley face. You just want to know what's going on in these regions, right? So again, predicting versus reacting, right? So it's ego versus execution. That's what you need, right? This is what you want to understand. So again, if you just take a look at the circled regions, right? What's going on at the top? What's going on at the top and the bottom of key levels? In other words, you need to understand if price is breaking above or below your level, what kind of volume are we looking at, right? What kind of market conditions are we looking at? Are buyers in control? Are sellers in control, right? Seriously, ask yourself these questions when you execute, right? There is no point predicting markets in 2026. You need to be reacting to what they tell you, right? So there's two ways to be a trader. You can sit there and you can predict and you can draw lines like Picasso, or you can react to what the market's telling you, right? So it's literally a case of ego versus humility at this point. Are you willing to read the market and adapt to its tunes, or are you just gonna be some charting addict, some gambling charting addict, right? I don't know what to call you. Right, aggressive sellers, no reward. Aggressive sellers, no reward. Now, what's interesting is we have green candles with large selling volume. We see that here, for example, right? We see that here. We see that here. We see green candles with large selling volume, which indicates to us very succinctly, right? Very clearly, very accurately, like the market is telling you, right? Assuming you have your right key level and got, whatever. There's a process to this, right? Which I'm going to go over in later videos. Assuming you have your right key level, all you need to do is read the buyers and sellers inside the key levels to make any kind of reaction to the trade, right? You're not predicting anything, you're reacting to the market, right? So are you predicting or are you reacting, right? Is it ego or execution? I'll let you decide. So the last thing I want to talk about is how the market does leave clues, right? So when you come to a market, your chart should look like this. You need to have levels of supply and demand, right? I don't like to use the word support and resistance because people think those are lines, right? No, these are very specific levels that have given you interactions between buyers and sellers, right? So this is the ES futures on the 15-minute time frame. Now, again, if you are trading without key levels, or more importantly, more broadly, if you are trading without reading the market's clues, then again, you are grossly egotistical, right? I'm not quite sure what you're doing. Now, this is a gold example, right? I get lots of questions about, does order flow work on gold? Yes, it does. Order flow does work on gold. And if you're trading gold without order flow, again, either click off this video and quit, or if you're interested, just keep watching. So what we can see here is one fair value gap with multiple taps. And so what makes the multiple taps valid is the fact that the order flow has shown us aggressive sellers have been rejected. And we see this multiple times, right? We see here, for example, we see huge aggressive buy orders before the market actually ranks higher. And we see these aggressive sell orders, right? So reading the order flow will give you an indication as to who is in control of the price. And so again, on the 15-minute time frame, what's interesting to see is that we had a demand area that flipped to supply. And so your job is to understand where these areas are and simply drag these zones to the right. Because your entry model or your entry is only as good as the position it is in the market, right? Your entries are only as good as your key level. I repeat that. Your entries are only as good as your key level. So if you don't have a key level that's backed with order flow and supply and demand, then again, it's ego versus execution, which is a common theme in this video, right? And just one thing to kind of finish up on, I guess, is your pre-market plan should have your supply and demand levels, right? So the way that I do my pre-market plan, I'll just finish off the video by kind of discussing how I do that. So if you want to avoid taking trades like this, what you want to really focus on is the buyers and sellers, right? So where are the buyers and sellers sitting, right? So the reason why I say you should get used to trading one market is because if you get good at one market, you get very kind of in tuned as to where the buyers and sellers are sitting, right? So I do like a basic analysis. So I do my structure highs and lows, low, high, low. I've got my premium up here. I've got my discount down here. It's the 50% that's in between this low and this high. And once I do that, I'm then looking to see where there's very specific interactions with price. Again, I can make a separate video about key levels later on if I want, which is a very requested topic. But we can see here supply, something I broke down earlier, supply, supply, and then of course we've started to break above this supply. So we can see here sellers in control, sellers in control, sellers in control, and now here, meh, it's a bit meh. So again, how do I know there's supply over here? Well, it comes down to this thing, doesn't it? Well, it comes down to you understanding, and more importantly, you just reading what the market's telling you, right? You don't need to reinvent the wheel, or you should not be reinventing the wheel. You need to look at the price action and say, okay, what is the price action doing? What are the buyers doing? What are the sellers doing, right? So this is a key level here, for example. Thursday, shorts above the weekly opening price. This is what was happening in that level, right? So that was the execution, and I think order flow I made yeah, there you go. So what was going on inside the level was we had the aggressive buy orders, right? So there was my execution here, 7 contracts on MES, risking about 30 to about 15 points to make probably like 20 points or something, not a huge risk to reward or whatever it was that day. But the question then becomes, if you're not trading without order flow, now I want to finish on this note. If you're not trading without order flow, then you shouldn't be trading at all, right? You shouldn't be trading the markets at all if you don't understand order flow, because what you're doing is you are trying to fly a plane without a license, blindfolded across the sea, right? You're going to crash. Like there's no two ways about it anymore. So if we look specifically at, we'll just finish off, right? So let's kind of let's go back to where we started, right? So we started here. So hopefully at the end of this video, I've given you something to think about. Maybe not change your mind forever, but I've given you something to think about. So if you're trading sweeps, you need to stop. If you're trading market structure shifts, understand why the shift actually happened. If you're trading fair value gaps or fair value gaps, you have a higher chance of winning the lottery in the long term. If you're trading support and resistance without understanding how they work, you're essentially flying that plane blindfolded across the sea. And trend lines, the angle of your trend line does not matter, right? And more importantly, your angle of 62 degrees or whatever it is will not be enough against a multi-trillion or billion-dollar market, ever. So I'm going to finish on this slide, actually. You cannot trade order flow without understanding these 4 points, right? So the market is an auction. It's not a show that's there to tickle your ego. Supply and demand governs the price of every market. The reason every market goes down is because of an oversupply. And the reason the market goes up is because demand outstrips supply, right? So when demand is bigger than supply, prices raise and you want to be in long, right? When markets tank is because there is an oversupply at that price at that time. Predicting markets instead of reacting to what they tell you is grossly egotistical, and you want to stop doing that. If you're interested in long-term trading and making profits, if you're just here to fulfill your daily, 60-minute charting addict, or even 5-hour charting addict, like a video game, then you don't need order flow. But order flow is there for consistent long-term, longevity, right? There's no other strategy that builds longevity, right? I've seen countless traders come and go, or, come full circle with the realization. And the last thing is that the market leaves clues of what it wants to do. So your job isn't to make up the clues or try and predict the clues or try and draw the clues or try and think you know the clues or go on Forex Factory and try and read the clues or watch the news and read the clues, or you even now use ChatGPT to try and read the clues. The clues are in front of you. Your job is to read them or at least understand what the clues are telling you. Then if you want to trade properly, the clues are there for you. Right, so that's kind of the note I wanted to leave on. So this is more of a mindset training for order flow. So once you understand that, we can then start to, in future videos, dive into the exact frameworks and templates that I use. But thank you very much.